We're starting off with a story that's been making waves in the tech industry. Artificial intelligence company Anthropic has been positioning itself as the intellectual and creative AI platform, with its models named after literary forms and its CEO styling himself as a thought leader. However, it looks like they have got some competition on their hands. Thinking Machines, a startup founded by former OpenAI leader Mira Murati, has just released its first AI model Inkling, which can be fine-tuned via its Tinker platform. The company says Inkling has 975 billion parameters and is an open weights model, meaning that core aspects of the model are publicly available. What's interesting here is that Thinking Machines is taking a similar approach to Anthropic, emphasizing the importance of enhancing human intelligence rather than replacing it. They are competing on customization, allowing consumers and enterprises to shape the AI in their own image rather than using a system that reflects the average preferences of the broader population. This trend towards more intellectual and creative AI solutions is something we're seeing across the industry. Companies like Chat Playground AI are also popping up, offering platforms that allow users to compare and contrast different AI models, refining outputs and optimizing results. It's clear that the demand for AI technology is on the rise, but it's also clear that consumers are looking for more than just a replacement for human thinking. They want something that will enhance their abilities, make them more productive, and provide them with a competitive edge. As we watch this space continue to evolve, one thing is certain: the companies that succeed will be those that can balance innovation with user needs, providing solutions that are both powerful and intuitive. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of tech and finance, where a significant shift is underway. Meta platforms, Nvidia, and Amazon are leading the charge in artificial intelligence development, and this has led to a massive borrowing spree. These tech giants have issued a record $182 billion in investment-grade bonds so far in 2026, accounting for approximately 15% of total U.S. corporate bond issuance year-to-date. This surge in borrowing has triggered caution among fixed-income investors, with credit default swap spreads increasing drastically. The 5-year CDS spreads on Oracle, Amazon, Google, and Microsoft have risen to around 75 basis points, near the highest in at least 7 years. This indicates that investors are demanding more protection against big tech credit risk. It's essential to consider the implications of this trend. On one hand, the AI revolution has the potential to drive significant growth and innovation. On the other hand, the rapid increase in debt levels could lead to increased risk and volatility in the market. As we navigate this complex landscape, it's crucial to stay informed and adapt to changing circumstances. The impact of this borrowing spree extends beyond the tech sector, with potential ripple effects on the broader credit market. As investors reassess their risk tolerance, we may see a shift in the way corporate debt is valued and managed. It's a story that will continue to unfold, and we'll be keeping a close eye on developments. The question on everyone's mind is, what's next for these tech giants and the credit market? Will they be able to manage their debt levels effectively, or will we see a correction in the market? Only time will tell. For now, it's clear that the AI revolution is reshaping credit markets, and investors must be prepared to adapt. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's take a look at the current market outlook. The Nifty 50 is expected to begin the coming week on a stable note while maintaining a positive undertone. Immediate resistance is expected at 24,500, followed by 24,780, and on the downside, 24,000 and 23,800 will act as important support levels. The weekly RSI stands at 51.49, remaining neutral without showing any bullish or bearish divergence against price. Pattern analysis shows that the index continues to recover after successfully holding the lower boundary of its broader trading structure. However, the recovery is now approaching a technically important supply zone near 24,500, where the 100-week moving average is placed. For investors, it's essential to maintain a balanced approach and stay selective, adopting a stock-specific approach while closely monitoring price behavior around the 24,500 zone. The relative rotation graph shows that certain sectors like realty, pharma, media, and mid-cap 100 indices are inside the leading quadrant, likely to outperform the broader Nifty 500 index. On the other hand, sectors like energy, infrastructure, and metal indices are inside the weakening quadrant, which may show a slowdown in their overall relative performance. It's crucial for investors to keep an eye on these trends and adjust their portfolios accordingly. As we conclude today's Riskwiser Zone, remember that investing in the market always involves risks. It's essential to stay informed, do your research, and consult with financial experts before making any investment decisions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.